$1,000. That's all you need to start building real wealth. Not 10,000, not 100,000. Just $1,000 invested correctly today becomes over $17,000 in 30 years. But here's the problem. Most people with their first $1,000 make one of three mistakes. They pick the wrong investment, they use the wrong account, or they wait too long trying to figure it out. By the end of this video, you'll know exactly where to put your first $1,000, the exact funds to buy, the exact account to use, and why this strategy beats 95% of professional investors. Let's break it down step by step. If you're new to investing for beginners, $1,000 feels like both a lot and a little at the same time. It's enough to get started, but not enough to waste on expensive mistakes. That's why this video exists. To show you the exact wealth-building strategy that maximizes every single dollar. No complicated stock picking. No risky crypto gambling. No expensive financial advisors taking 3% fees. Just simple, proven personal finance that works for real people. Here's what we're covering. First, the exact allocation, where every dollar of your $1,000 goes. Second, the specific funds to buy, the actual ticker symbols you'll type into your brokerage account. Third, the account type that saves you the most on taxes. And fourth, the automation setup that makes this work on autopilot. This is financial education that actually moves the needle, not theory. Action. And here's the best part. Once you understand this strategy for your first $1,000, you can scale it to $10,000, $50,000, $100,000. The principles stay exactly the same. Ready? Here's where your first $1,000 goes. My first $700 would go into a total stock market index fund. 70% of your money. All in one fund. This is the foundation of wealth building. Why 70%? Because stocks have the highest long-term returns. The S&P 500 has averaged 10% annually for the last 50 years. Total market funds own every publicly traded company in America. Instant diversification across 3,500 stocks. You're not betting on one company, you're betting on the entire American economy. And over decades, that bet has never lost. The specific fund I recommend? VOO. That's ticker symbol VOO. The Vanguard S&P 500 ETF. Expense ratio 0.03%. That means you pay $3 per year for every $10,000 invested. Compare that to actively managed funds charging 1 to 2%. On $1,000, that's $10 to $20 per year. Doesn't sound like much. But over 30 years, those fees cost you thousands in lost compound interest. VOO tracks the S&P 500, the 500 largest companies in America: Apple, Microsoft, Amazon, Google, Nvidia. You own all of them with one fund. $700 into VOO. That's step one. My next $200 would go into a dividend growth fund. 20% of your money. This adds income and stability to your portfolio. Dividend funds own companies that pay you cash every quarter just for holding the stock. Think Coca-Cola, Johnson & Johnson, Procter & Gamble, companies that have paid increasing dividends for 25 plus years. The specific fund? SCHD, ticker symbol SCHD. The Schwab US Dividend Equity ETF. Expense ratio 0.06%. Current dividend yield around 3.5%. That means your $200 generates about $7 per year in dividends. Doesn't sound like much now. But as you add more money and dividends grow, this becomes a powerful income stream in retirement. $200 into SCHD. That's step two. My last $100 would go into international stocks. 10% of your money. This gives you exposure to growth outside America. Why international? Because the US stock market is only 55% of global market value. The other 45% is Europe, Asia, emerging markets. You want some exposure to that growth. The specific fund, VXUS, ticker symbol VXUS. The Vanguard Total International Stock ETF, expense ratio 0.07%, owns over 8,000 companies across dozens of countries. $100 into VXUS. That's step 3. So here's your complete allocation. $700 VOO, $200 SCHD, $100 VXS. Total, $1,000. Fully invested. Maximum diversification. Minimum fees. This is money management simplified. 3 funds. 3 ticker symbols. Done. Now let me show you why this matters. This is where compound interest becomes life-changing. Your $1,000 invested in this allocation, assuming 8% average annual returns. Conservative estimate based on historical data. After 10 years, you have $2,159. You more than doubled your money. After 20 years, you have $4,660. Almost 5 times your initial investment. After 30 years, you have $10,627. Over 10 times your original $1,000. But here's where it gets interesting. What if you don't just invest $1,000 once? What if you add just $100 per month? Same allocation? Same funds? Just $100 per month on top of your initial $1,000. After 10 years, you have $19,335. You contributed $13,000 total. The market added $6,335. After 20 years, you have $61,680. You contributed $25,000 total. The market added $36,680. After 30 years, you have $150,299. You contributed $37,000 total. The market added $113,299. Let me say that again. You put in $37,000 over 30 years. The market turned it into $150,000. That's the power of compound interest. And this assumes you never get a raise. Never increase your contributions. Never add windfalls or bonuses. Just $100 per month for 30 years. Now imagine you do increase contributions as your income grows. Start with $100 per month. Increase to $200 after 5 years. $300 after 10 years. You could easily hit $500,000 to $1 million by retirement. From a $1,000 start and consistent monthly contributions. This is wealth building for real people, not trust fund kids, not 6-figure earners. Regular people who start with $1,000 and stay consistent. So where do you actually open this account? This matters more than most people realize. You have 3 main options: a taxable brokerage account, a traditional IRA, or a Roth IRA. For most beginners, the Roth IRA is the best choice. Here's why. Roth IRA contributions are after tax. You pay taxes on the money now, then it grows completely tax-free forever. When you retire and withdraw the money, you pay 0 taxes. Not on the gains, not on the dividends. Nothing. Compare that to a taxable account. You pay taxes on dividends every year. You pay capital gains taxes when you sell. Over 30 years, those taxes can cost you 20 to 30% of your total returns. The Roth IRA eliminates all of that. Your $1,000 grows to $10,000, or $100,000, or $1 million, all tax-free. Plus, Roth IRAs have another huge benefit. You can withdraw your contributions anytime without penalty. Not the gains, just your original contributions. So if you invest $1,000 today and need that $1,000 back in 5 years for an emergency, you can take it out. No taxes, no penalties. The gains stay invested and keep growing. This makes the Roth IRA perfect for beginners. You get tax-free growth, flexibility for emergencies, and forced long-term investing discipline. Where do you open a Roth IRA? 3 best options: Vanguard, Fidelity, Charles Schwab. All 3 are excellent, low fees, great platforms, easy to use. Pick whichever interface you like best. Opening an account takes 10 minutes. Link your bank account. Transfer your $1,000. Buy your 3 funds: VOO, SCHD, VXUS. Done. You're now officially an investor. Here's the final step that separates successful investors from everyone else. Automation. Don't rely on willpower to invest every month. Automate it. Set up automatic transfers from your checking account to your Roth IRA. Same day, every month. Same amount. $100 or $50 or whatever you can afford. Then set up automatic investments. Every time money hits your Roth IRA, automatically buy your 3 funds in the same allocation. 70% VOO, 20% SCHD, 10% VXS. Most brokerages let you set this up once. Then it runs forever without you touching it. This is money management on autopilot. You never forget to invest. You never try to time the market. You never let emotions derail your plan. You just contribute. Invest. Repeat. Month after month. Year after year. Decade after decade. And here's what happens. You stop thinking about it. Investing becomes as automatic as paying your electric bill. 5 years pass, you check your account. You have $15,000. You barely remember contributing most of it. 10 years pass, you have $40,000. You're shocked at how much it grew. 20 years pass, you have $150,000. You realize you're actually going to retire comfortably. That's the power of automation plus compound interest. Small, consistent actions compound into life-changing results. Before we wrap up, 3 mistakes to avoid. Mistake 1, waiting for the perfect time to invest. There is no perfect time. The best time was yesterday. The second best time is today. Trying to time the market costs you more than any market downturn ever will. Mistake 2, picking individual stocks instead of index funds. 95% of professional fund managers can't beat the S&P 500 over 10 years. You won't either. Stick with index funds. Mistake 3, checking your account every day. The market goes up and down constantly. Daily volatility will freak you out and make you sell at the worst times. Check your account once per quarter or once per year, not every day. Avoid these 3 mistakes and you'll outperform most investors. Here's everything you need to remember. Your first $1,000 gets split 3 ways. 700 into VOO, 200 into SCHD, 100 into VXUS. Open a Roth IRA at Vanguard, Fidelity, or Schwab. Set up automatic monthly contributions. Set up automatic investments. Then let compound interest do the work. This is personal finance that actually builds wealth. Not complicated, not expensive, not risky. Just simple, proven investing that works for real people. Your $1,000 today becomes $10,000 in 30 years. Add $100 per month and it becomes $150,000. Keep going and you'll hit $1 million. This is how regular people retire rich. Not through luck, not through inheritance, through starting with $1,000 and staying consistent. Don't wait another day, open that account.